Investing. It sounds complicated, right? Like something only rich people do. But that's not true. Investing is simply planting seeds for your future. It's about putting your money to work for you. Think of it like this. You work hard for your money. But what if your money could work hard for you too? That's what investing does. It helps your money grow over time. Why is this important? Because investing helps you achieve your financial goals. It could be buying a house, retiring early, or securing your children's education. Investing is not about getting rich quick. It's about building wealth slowly and steadily. It's about taking control of your financial future. Let's start with stocks. Stocks represent ownership in a company and are a fundamental part of the financial market. Imagine you own a piece of your favorite company. This means you have a stake in its success and growth. That's what owning stock is like. You become a shareholder, which means you have a claim on part of the company's assets and earnings. You're a part owner, even if it's a small part. This ownership can be both exciting and rewarding. When the company does well, the value of your stock goes up. This increase in value can lead to significant financial gains over time. You can then sell your stock for a profit. This is one way investors make money in the stock market. Some companies also pay dividends, which are a share of their profits given back to shareholders. Dividends can provide a steady income stream. Of course, there's risk. If the company doesn't do well, the stock value might drop, leading to potential losses. That's why it's important to do your research and invest in companies you believe in. Understanding the market and the companies you invest in is crucial. For example, let's say you invested $1,000 in a company and its stock price doubled. This kind of growth can significantly boost your investment portfolio. Your investment would be worth $2,000. This demonstrates the potential for substantial returns. That's the power of stock market growth. Over time, the stock market has shown a tendency to increase in value, rewarding patient and informed investors. Now, let's talk about bonds. Imagine loaning money to the government or a company. They promise to pay you back with interest. That's a bond. Bonds are generally considered less risky than stocks. They offer a steady stream of income through interest payments. However, their potential for growth is usually lower than stocks. For instance, if you invest $1,000 in a bond with a 5% interest rate, you would earn $50 per year. This consistent income stream makes bonds attractive to many investors. Remember, investing is about finding the right balance between risk and reward. Bonds offer a relatively safe way to grow your money steadily over time. Next up, real estate. This is about owning physical property, like houses or land. Real estate is a tangible asset that you can see and touch, unlike stocks or bonds. People make money in real estate in two main ways: rent and appreciation. These methods can provide a steady income and long-term wealth. Rent is when you charge people to live in your property. This can be a reliable source of monthly income. Appreciation is when the property value increases over time, and you sell it for a higher price than you bought it. This can result in significant profits. For example, let's say you buy a house for $200,000. Over the years, the value of the house can increase. You rent it out for $2,000 per month. This rental income can help cover your mortgage and other expenses. That's $24,000 per year. This steady income can be very beneficial. Plus, if the house value goes up to $250,000, you make a profit when you sell it. This is the power of appreciation. Real estate can be a good investment, but it also requires money upfront and ongoing costs like maintenance. It's important to plan and budget for these expenses. Section 5. Investing with a safety net. Mutual funds. Now, let's talk about mutual funds. Imagine a basket filled with different stocks and bonds. This basket is managed by a professional. That's a mutual fund. Mutual funds allow you to invest in a diversified portfolio of assets without having to pick individual stocks or bonds. They are a good option for beginners because they offer instant diversification and professional management. For example, you could invest $1,000 in a mutual fund that holds stocks of 50 different companies. This diversification helps reduce risk because even if some companies don't perform well, others might. Remember, diversification is key to minimizing risk in investments. Mutual funds provide an easy way to achieve this diversification from the start. Section 6. The power of diversification. You've probably heard the saying, "Don't put all your eggs in one basket." This is especially true for investing. When you diversify, you spread your investments across various financial instruments. Diversification is about spreading your money across different asset classes. Why is diversification important? Because it reduces risk. If one investment goes down, the others can cushion the fall. This way, your overall portfolio remains more stable. Think of it like this. You wouldn't want all your money in just stocks, right? Stocks can be volatile and unpredictable, because if the stock market crashes, you could lose a lot. This can be financially devastating. But if you have some money in stocks, some in bonds, and some in real estate, you're more protected. Each asset class behaves differently. Diversification is about finding the right mix of investments that aligns with your risk tolerance and financial goals. It's a personalized strategy. It's about building a strong financial foundation that can weather market fluctuations. This approach helps ensure long-term financial health and peace of mind. Section 7. Time. Your greatest ally in investing. One of the most important factors in investing is time. The earlier you start, the more time your money has to grow. This is due to the power of compounding. Compounding is like earning interest on your interest. It's like a snowball effect. For example, let's say you invest $1,000 and earn a 7% return each year. After 10 years, you'll have over $1,900. After 20 years, you'll have over $3,800. The longer you invest, the more powerful compounding becomes. So, don't wait to start investing. Time is your greatest asset. Section 8. Start your journey to financial freedom. Investing might seem intimidating at first, but it doesn't have to be. Start small, learn as you go, and don't be afraid to ask for help. Remember, investing is not just for the wealthy. It's for anyone who wants to take control of their financial future and build a solid foundation for themselves and their families. Start today. Plant the seeds for a wealthier tomorrow. Your future self will thank you for it. Your future self.